All right, I want to ask you something, and be honest.
Yeah, I think we've all been there. It is one of the most frustrating feelings in all of investing, right? You see the opportunity, you're waiting for it to get just a little bit better, and then poof, it's gone. The train left the station without you. What's going on, finance people? It's Josh here. Welcome back to JoshLM Finance. Let's break this down. Today, we're talking about the strategy that's built to solve that exact problem. Dollar cost averaging, or DCA. Look, it's the boring strategy that quietly wins because it's built on one thing, and that's pure consistency.
Okay, so let's just get right into it. Here's a truth that might be a little uncomfortable. Most people, allegedly, don't lose money in crypto because they picked a bad asset. They lose money because their timing is just terrible. They let their emotions drive the bus, and well, that is a surefire recipe for disaster.
And this slide right here, this captures the two mindsets perfectly. Over on the left, you've got the market timer. They see a huge green candle, that FOMO kicks in, and they buy right near the top. And then when the market dips, they just freeze up. They're paralyzed by fear. They end up panic selling at the bottom, only to buy back in later when the price is higher. It is a stressful, exhausting cycle. But the DCA investor on the right, they're just calm. They buy on their schedule, they ignore all the noise, and you know what? They just sleep a whole lot better.
I love this slide because it just illustrates the point perfectly. Trying to time the crypto market, it's like trying to predict Lagos traffic. I mean, you might get lucky one day and just cruise right through, but trying to nail that every single day, it's a fool's errand. You're just going to end up stressed out and late. The market's the same. You have to stop trying to predict the unpredictable.
So if trying to time the market is the problem, then dollar cost averaging is the elegant solution. It is a system, it's a framework designed to take your emotions completely out of the equation and just force you to show up consistently. It's as much about building your own psychological discipline as it is about building your portfolio.
So what even is DCA really? It breaks down into three super simple parts. 1. A fixed amount of money, let's say $50. 2. A fixed schedule, like every single Friday or maybe the first of every month. And 3, this is the most important part. You do it regardless of the asset's price. I don't care if Bitcoin is up 20% or down 20%, you buy. No second guessing.
This right here is probably the best analogy for it. Think about it. You need to get to work, right? You don't just sit at home for 3 weeks hoping gas prices are going to drop by 10 cents. No, you just go to the station, you fill up the tank, and you move on with your life. DCA applies that exact same practical, unemotional logic to investing.
Okay, so that's all the theory. Let's make this real. Let's look at a practical example of how this would actually play out with your own money. Okay, so let's say you decide, I'm going to invest $100 every single week into Bitcoin. So in week 1, the price is at $50,000. Your $100 gets you 0.002 Bitcoin. Pretty simple. But then in week 2, the market is just euphoric, and the price doubles to $100,000. Your same $100 now only buys half as much, 0.001 Bitcoin. Did you see what just happened? Without you having to make any emotional decisions, the system, it automatically made you buy less when the price was high. And the reverse is also true. If the price had crashed, your $100 would have automatically bought you more. You're buying more when there's fear in the market, and you're buying less when there's greed. It is absolute genius in its simplicity. And you know what the best part is? You don't even have to remember to do it. Almost every major exchange you can think of, Coinbase, Kraken, Binance, you name it, they have a recurring buy feature. You can set it up one time, say $20 a week, and just let it run quietly in the background. You set it, and you just forget it. Now, you might be thinking, okay, Josh, this sounds fine for stocks, maybe, but what about crypto? Well, here's the thing. Crypto's famous volatility, the very thing that scares most people away, is actually what makes DCA such a ridiculously powerful strategy. It turns that volatility from a threat into a huge advantage. Just let this number sink in for a second. Bitcoin has historically had these massive drawdowns, dropping 50, 60, even 80% from its all-time highs, and this has happened multiple times. Now, when that happens, the emotional investors who are waiting for confirmation that the bottom is in, they almost always buy way too late. And the people waiting for one last dip, they often miss the rocket ship entirely. A DCA strategy, it doesn't care about any of that. It just keeps on buying week after week. And it all comes back to this classic, powerful quote. Your goal is not to be some kind of genius who perfectly times every single peak and every single valley. Your goal is to accumulate over a long period of time, being in the market through all of its ups and downs, That's what generates long-term returns, not trying to jump in and out at the perfect moments.
All right, but let's be real here for a minute. No investment strategy is perfect, and that includes DCA. It's a fantastic tool for sure, but it's not some kind of magic bullet. It has limitations, and you absolutely need to be aware of them. So, you got to know the trade-offs. First off, if the market just goes straight up in a line without any dips, a big lump sum investment right at the beginning will actually give you a better return. The only catch? You only ever know that in hindsight. It's a huge gamble. Second, DCA will not save you from a bad investment. If you are consistently buying an asset that is slowly bleeding to zero, you're just going to consistently lose money. And finally, you have to watch out for fees. Making a lot of small buys can add up. So just make sure you're using a platform that has low costs for these kinds of recurring transactions.
So if you're going to do this, you got to do it right. Here are 5 simple rules to follow. Number 1, only invest money that you can afford to lock away for the long term. This is not your emergency fund. Number 2, automate it. Do not rely on your own willpower. 3, stop checking the price every single day. Seriously, just review your portfolio maybe once a quarter. 4, stick to high-conviction assets, things you actually believe in for the long haul. And number 5, just check in once a year to see if you can maybe adjust your investment amount based on any changes in your income.
At the end of the day, this slide right here is the entire philosophy boiled down into one sentence. The market does not reward you for being the smartest person in the room or for making these brilliant, flashy moves. It rewards you for your patience and for your consistency. Boring wins.
And of course, I have to give the important disclaimer, none of this is financial advice. This is all for educational purposes only. I'm just sharing concepts and my own perspective. You should always do your own research and make decisions that are based on your personal situation and your own risk tolerance. You know, it's funny. In the crypto space, the loudest people are usually the ones chasing the tops and shouting about the next 100x coin. But the quiet ones, they're often the ones just buying a little bit every single week, sleeping better, and just winning slowly. Thanks for watching till the end. If this helped you, you know what to do. I'll see you in the next one. Take care. Peace.